Every trader has asked the same question: after a strong move, where does it stop? The answer, according to price action theory, lies in a concept called the measured move, or It's a simple geometric projection that many believe reveals the hidden profit targets of institutional players. In this DeepQuant analysis, we'll break down two practical ways to use examine real trade examples, and confront the uncomfortable truth: does not predict the future, it only maps a zone of probability. By the end, you'll have a tool that can sharpen your entries and exits, but also a healthy skepticism about its limits. A measured move is a technique used to estimate where a second impulse might end, based on the length of the first impulse. Imagine a strong downward trend that pauses, then resumes. The theory suggests that the second leg often travels a distance equal to the first leg, projected from the pause point. This is not a law of physics, but a heuristic based on the idea that institutional algorithms and human traders often set profit targets at these proportional extensions. The can be applied to any time frame, but it's most effective when combined with other confluence factors like support and resistance levels. The core formula for a measured move is straightforward. First, identify a strong impulse leg either up or down. Measure its length from the start to the end. Then, from the point where the market pauses or consolidates, project that same length in the direction of the original impulse. The projected endpoint is your target. This is a purely geometric calculation, not a statistical one. It assumes that the second leg will mirror the first in magnitude. In practice, you might see targets hit exactly, overshoot, or fall short, which is why should never be used in isolation. Why would institutions care about a simple geometric projection? Because they need to place large orders without moving the market against themselves. By setting profit targets at levels that are easily identifiable to other market participants, they can exit positions into liquidity. The provides a common reference point that many traders and algorithms watch. When price approaches these levels, a cluster of sell orders or buy orders can emerge, creating a self-fulfilling prophecy. This is not to say is a secret institutional code, but rather a widely used heuristic that influences market behavior. There are two primary ways to apply the measured move. The first is the range breakout Here, you identify a consolidation range with clear support and resistance. When price breaks out of that range, you project the height of the range from the breakout point to estimate the target. The second is the strong impulse After a powerful directional move, you measure that move and project it from a subsequent pullback or consolidation to estimate where the next leg might end. Both methods share the same principle, using the length of a past move to project a future target. Let's look at a concrete example. Suppose a currency pair has been trading in a range between 1.1000 and 1.1200, a height of 200 pips. If price breaks below the range at 1.1000, the range breakout projects a target of 1.0800. In this historical example, price indeed fell to that level before reversing. This illustrates the basic mechanics of the range breakout However, note that the target is not guaranteed, it's a zone where price might react. The calculation for a range breakout is simple. First, determine the range height by subtracting the lower boundary from the upper boundary. Then, depending on the direction of the breakout, add or subtract this height to the breakout price. For a downward breakout, the target is the breakout price minus the range height. For an upward breakout, it's the breakout price plus the range height. This gives you a specific price level to watch. In the example we saw, the range height was 200 pips, and the target was 200 pips below the breakout. Consider a strong bearish impulse that drops from January 2000 to 1.1500, a move of 500 pips. After a brief consolidation, price breaks down again. The strong impulse projects a target of 1.1000, which is another 500 pips below the consolidation point. In this historical chart, price reached that level and bounced. This shows how the can be used to anticipate a potential reversal zone. Again, it's not a guarantee, but a high probability area. The strong impulse calculation is similar. Measure the length of the initial impulse, from start to end. Then, from the end of that impulse, which is typically the start of a pullback or consolidation, project that same length in the direction of the impulse. For a bearish impulse, you subtract the length from the end point. For a bullish impulse, you add it. This projected level is your target. In our example, the impulse was 500 pips, and the target was 500 pips below the consolidation. The measured move can be a powerful addition to your trading toolkit. For entries, you can wait for price to reach an target and look for reversal signals, such as a bullish engulfing pattern or a hammer, to enter countertrend. For exits, if you're in a trade that's moving in your direction, you can use an target as a logical place to take profit. This helps you avoid giving back gains. However, it's crucial to combine with other forms of analysis, such as support and resistance, trend lines, and candlestick patterns, to increase the probability of success. I saw the target and entered immediately, but price reversed before reaching it. I used to short, but the overall trend was up, and I got crushed. Price blew through my target, and I didn't know what to do. These mistakes highlight the need for confluence and flexibility. Let's summarize the key points. First, is a spatial judgment, not a prediction. It tells you where a move might stop, not that it will stop. Second, there are two main types, range breakout and strong impulse Both rely on projecting a measured length. Third, works best when combined with other technical tools and market context. Fourth, always use stop losses and position sizing to manage risk. Fifth, practice on historical charts to build intuition. Sixth, be aware that can fail, and that's okay. The measured move is not limited to Forex. It can be applied to stocks, indices, commodities, and cryptocurrencies. The underlying principle is the same. Markets often move in waves, and these waves tend to have proportional relationships. For example, in a stock that has a strong rally, a pullback, and then another rally, the second rally might equal the first in length. In crypto, where volatility is high, can still be useful, but you should expect more overshoots. Always adapt your approach to the market's character. The measured move is a simple yet profound concept that can help you think about where price might go. It's not a crystal ball, but a framework for understanding market structure. By mastering the two methods we've discussed, you can improve your timing and avoid chasing moves that are already extended. Remember, trading is about probabilities, not certainties. Use as one tool in a comprehensive strategy that includes risk management and emotional discipline. We'd love to hear how you use in your own trading. Markets reward discipline, not certainty. If this analysis helped, like the video and subscribe to DeepQuant. Tell us in the comments which market idea we should test next. Evidence beats noise. Control risk before chasing returns.